I applaud you for taking some time this evening and sharing your time with me. I have some what I believe to be great content to go over with you. Happy to do so. I am going to try and go brisk so I can leave a little bit of time towards the end of the hour for some Q&A. I was actually tweaking some of these slides right before the top of the hour here, so I've made a couple of quick changes and updates, but it's all good stuff. So, all right, we've got a lot of people on tonight. Again, thanks for joining me. Tonight, I am going to go over my presentation here, which I just simply titled How to Earn 15% Interest and Beat Inflation with Promissory Notes. So I'm going to divide the presentation into two basic halves. The first is about inflation. You might think you know what you know, and it may be accurate, but it's also good to have an idea of what inflation is and how it impacts you. The second half is going to talk about how I beat inflation and ways that you can too. We're going to talk about promissory notes, what they are, how they work. It is pretty simple, but a lot of people still don't fully understand how it all works. I don't have a co-host or a moderator tonight, so it's just me flying solo. If I assume you can hear me. If you can, maybe one or two of you can just type in the chat box that you can hear me, so I know I'm not talking to myself all night. And I will also keep it up for later, so I can refer to it for some Q&A. And in fact, let me open up the Q&A box right now. Okay, I'm going to get started. So I'm going to, chat is disabled. Yes, we can hear you. Thank you. Actually, you know what? I think in a webinar, the chat is disabled by default. So it would be the little Q&A button that you see at the bottom. Yeah, Melanie, thank you. Melanie, nice to see you. All right. So, okay, we know the Q&A box is working, and I know you can hear me. Awesome. And I assume you can see my first slide. So with that, let me jump right in. Like I said, I'll leave some time for Q&A later, and bear with me because I am doing this on my own tonight. I don't have my marketing team with me. So, all right. So let's just get started. First, just a really, really quick disclaimer. This is for general information purposes only. These are my opinions and my experiences that I'm sharing with you. I'm not giving specific legal or financial advice or recommendations. This is for educational purposes only, and we are not financial advisors. Always do your own research, no matter what you're investing in, whether it be real estate, crypto, or anything else. So with that disclaimer, let me jump right in. I'm going to start off with a quote that I absolutely love. It's by Milton Friedman. He's one of my favorite economists. He said years ago, inflation is taxation without legislation. How true is that? We are constantly surrounded by inflation, which we cannot escape. It impacts and affects all of us. And we didn't vote for it. We didn't want it. We didn't ask for it. It's basically just presented and given to ourselves. So Milton, if you have never heard of Milton Friedman or read his books, he's great. Milton was an American. He passed away. He was an American economist and statistician, and he received the 1976 Nobel Prize for Economic Sciences. So he's done a tremendous amount of research on monetary policy, history, theory, complexity. He's just a very interesting person. Believe me, it won't let your eyes glaze over. His books, most of his books are pretty easy to read and follow. But I really love this quote. Another quote that I really like is by former President Ronald Reagan. He said, "Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman." That's pretty bold and blunt, but you know, when you stop and think about it, it's kind of true in a very figuratively speaking way. So we're talking about inflation, something that we really don't like. So what are the 6 things I want you to learn today? These are what I'll call my takeaways for you. Why is inflation a wealth killer? How do you beat high inflation today? Because we've been seeing very high inflation here for a while, probably a little bit too long, but certainly for the last couple of years. What are my four favorite inflation hedges. There's really three core ones, but I'm going to share four of them with you. What exactly is a promissory note? And how can some, not all, promissory notes help protect you against inflation? It's actually a very simple answer, and it's really just a basic math formula. Last but not least, how can you earn as much as 15% or even more on your cash savings and in your retirement accounts, which happens to be a very, very popular place for investors to be investing in promissory notes today, especially after the roller coaster ride of late in the stock market. And we hear this from clients time and time again. So real quick, 60 seconds or less about who am I. I think many of you on this webinar know who I am or know about me. But for those of you who don't, I'm a two-time Inc. 5000 entrepreneur. I am a very avid, active investor, actively and passively, author and the founder of several companies. The two most prominent and public-facing companies are Norada Capital Management and Norada Real Estate Investments. The latter is one of the largest, if not the largest, nationwide providers of turnkey cash flowing investment property. We started that company 19 years ago this month. So this month is our 19th anniversary, and things are going strong, so I can't complain. I'm also the host of a very popular top 50 iTunes podcast called Passive Real Estate Investing. We talk about everything related to real estate investing, to housing and the economy, mindset, personal development, anything that I deem to be helpful to you as an investor, not just a real estate investor. So it's not all about real estate, but check it out. It's available literally on every single platform. Or you can go to passiverealestateinvesting.com with links to all the various syndicated services. I started when I was 18 years old. I bought my first rental property. I had to wait until I was 18 to qualify for financing. Otherwise, I would have pulled the trigger at 16. But I renovated and managed my own rental as early as 18, and the writing was on the wall, and I just continued to go from there. And then I hit the gas pedal really hard in 2003 and 4. At that time, I acquired 84 doors in a 9-month period. So I built up a very large portfolio in a very short period of time. Now, granted, it was much easier to do back then because credit was a lot easier. You know, they used to say that if you could fog a mirror, you could get a loan. You know, if you remember the stated income loans, even the ninja loans, the no income, no asset, no job loans, credit was pretty easy to get back then. Last but not least, just as a side, I've invested in pretty much every asset class, including cannabis and crypto. Last but not least, I am the co-producer on 6 new Broadway musicals. I will touch on that later because they are part of the Norada Capital Management. They're part of our firm. So that's a little bit about myself. Moving on. I always like to start my speeches and presentations, especially when I'm in front of a live audience, with this slide and this question. Now, some of you have heard me say this before, so you'll know the answer, and that's all well and fine because nobody else on the webinar can hear you. So it won't be a giveaway, but I always ask them to finish this question or finish this statement. Ignorance is blank. Now, what do you think most people say? If you're like most people, the first thing that comes to mind or the first thing you say is that ignorance is bliss. Now, there is some truth in that, and that may be true in some cases. I just don't like that saying. For me, ignorance, and I learned this at a very young age, ignorance is expensive. You see, this speaks to the saying that what you don't know won't hurt you, and that's absolutely wrong. Ignorance comes with a tremendous price to pay. And what's worse is that those people who are ignorant, not all the time, but ignorant in certain times, they never realize this. They don't realize that there's a tremendous price to pay. The cost of ignorance, I like to say, is much greater than the price of education. Now, let me repeat that. The cost of ignorance is much greater than the price of education. Ignorance is an expense and a penalty. Education is about learning and knowledge. I find that education enhances your life and your understanding, whereas ignorance prevents you from learning. It's by definition, a way to, stick your head in the sand and not learn, not expand your mind. But ignorance prevents learning, growth, and improvement. And I've said many, many years ago that without knowledge, good knowledge, proper knowledge, you are doomed to follow other people's advice without knowing if it's good or bad. If you have the right knowledge, it will help take you from being a good investor to becoming a great investor. And that knowledge will help provide a passive stream of income and create wealth for you and your family. So this is why I'm such a big advocate and big believer in education and knowledge. And I really wish the school system would put more financial education and knowledge in the school system. All right, so that's some food for thought. Hopefully, that'll give you some takeaways and something to chew on later, if nothing else. So this is a very interesting slide. There were about 19,000 adults surveyed in 27 different countries. And these are adults from 16, well, they're not all adults, but basically people from 16 to the age 74. And this was done over a 2-year period. And they were asked the question, what are your greatest concerns? And we're talking global concerns, not, household and whatnot, but what are your top global concerns for the last 2 years? What's interesting about the answers to that question was, number one, coronavirus obviously was dropping like a hammer. The concern for coronavirus was dropping rapidly, especially since the beginning of 2021. So, and that's because people were getting tired of it, and there were vaccines out, and there were all kinds of solutions, and people were basically moving past it. But that was to be expected. Secondly, unemployment and jobs was also on the decline, which made sense because the job market was very tight. There were a lot of job openings out there. People could move quickly, laterally, or even move up in terms of employment. So that wasn't a big concern. It was pretty easy to get a job. And so that concern was dropping. But here's the big one, and here's the important one, in my opinion. Inflation. Concerns over inflation were growing rapidly, especially as we went into 2021. And that's because of many reasons. Some of them have to do with fiscal and monetary policy. Some of them have to do with supply chain constraints, which was a fallout from the coronavirus lockdowns around the world. It just created all kinds of supply issues, and demand was still there. So inflation was going up, and it was compounded by the fact that central banks and governments around the world were pumping all kinds of new money or currency into the system, causing monetary inflation. So we had two things going on at the same time. We had price inflation because demand was still there, but supply was dropping, creating an imbalance, pushing prices up. Then we had monetary inflation, which was putting more currency into the system, and all that extra money sloshing around was looking for a place to go. And that just is part of monetary policy. It's just how money works. It causes inflation, and not right away. It has to work itself into the system. But inflation can be bad. So what the heck is inflation? Well, I'm going to answer that question right now. Inflation is very simple. It is just when the purchasing power of your dollar, the currency, decreases, and it decreases over time. And it has been since essentially 1913, when the Federal Reserve was first increased. Now, it didn't happen right away, but it did start happening as the decades went by. So inflation is, you could say, a bad thing. Inflation increases the price of goods and services over time, and this erodes the purchasing power of your money. And I can illustrate that with a cup of coffee. So this is how inflation has changed the price of a cup of coffee over time. You see, back in the 1970s, you can get a basic cup of coffee for about 25 cents, a quarter. And after each and every decade, you can see that the same cup of coffee has gone up in price. Did the cup of coffee change? Probably not. It's still a cup of coffee. But the price goes up year after year, decade after decade. And it's not because the coffee's gotten better or the size of the cup has increased. In fact, the value you get from that cup of coffee is pretty much the same thing. The price is the same. The value is the same. no, excuse me, the price has gone up, but the value is the same. And so that's the issue with inflation, is the purchasing power of your dollar is decreasing, but you're getting the same value for the same goods and services at a higher price. So what's interesting about this is that in many cases, for a lot of commodities, the price is going up and you're getting less for the dollar. And so inflation, although nominally speaking, looks like you're getting less, in reality, you are getting less in many cases. So the goods and services that inflation typically affects are often commodities like fuel, metal, foods, grains, utilities such as transportation and electricity, and then services such as labor and even healthcare and entertainment. So all these things tie into manufacturing, which increases the cost of production, which increases the cost of the goods and services that you buy. And so this is why you see prices going up all over the place. Just as a side note, don't confuse value and price. Those are two different things. Value is what you get, price is what you pay. And so you obviously want to know that you're getting the right value for whatever you're purchasing with the dollar, but that's always a moving target. So this is a simple illustration of what inflation is. And people tend, especially talking heads in the media, tend to overcomplicate this thing. Now, you can get into the weeds and look at, what are the driving factors with inflation and all that good stuff. But this is really all you need to understand, is that if you don't keep up with inflation, if you don't keep up with the purchasing power that's being lost, you are losing money, literally and figuratively. You're losing money every year because you're losing purchasing power. So I need to update this chart. This is a couple months old, but it's basically the same chart. And so what we see here is the rate of inflation since the mid 1960s. And you can see it gyrates quite a lot. Now in August, the rate of inflation, the CPI, the Consumer Price Index, was 8.3%. It dropped a little bit since then, as you'll see in the next slide. But if you take an average, the inflation rate in the US has averaged about 3.7%. If you go back to 1960, if you go back to 1920s, it was more like 3.3%. So it hasn't changed all that much if you want to go back about 100 years. But inflation has been there almost all the time. There was a dip after the Great Recession of 2008 where we had negative inflation, but obviously that was short-lived, and there's reasons for that too. So now the question is, how do you beat inflation? You don't want to meet inflation, you want to beat it. And you certainly don't want to lag behind it, because then you're losing money and you're becoming poor, not richer. You're becoming less wealthy. It's very, very simple. You have to earn investment returns that are greater than the actual or the anticipated rate of inflation, which means if you're beating the rate of inflation, then you are ahead of the game. You are making money, as they say. But in order to understand this concept, this formula for beating inflation, you have to understand two important things. And this is about as complicated as it's going to get tonight. There's the nominal rate of return on any investment. This is basically the face value. What are you getting paid? If it's 6%, it's 6%, but that's, those are in nominal terms. It's in name only. That's what nominal means. So, and then your nominal rate of return is the profit you earn on any investment before you adjust for that rate of inflation. The real rate of return is the profit you earn on an investment after you adjust for inflation, which simply means you're deducting the rate of inflation off of that return, and that's what your net return is. So your real rate of return is your net rate of return. It's what you actually own at the end of it all. And I'm going to give you an example, two of them on the next slide, but we have to establish what is the current rate of inflation. This is normally measured by the CPI, the Consumer Price Index. Now it's gone down, as I showed you. It was about 8.3% in August. Right now, as of December, we're recording this in January. As of December, it was 6.5%. This is what the Fed, the Federal Reserve, wants to see. They want to see a continuing month over month decline in the rate of inflation. This is what they're trying to do, is drop that rate of inflation, which is good, but it comes at other expenses. And you can listen to I believe the last episode of my podcast I'm not sure if it was released, but I actually interviewed a prominent economist out of New York. And it was a very interesting conversation talking about inflation. But anyway, I digress. So 6.5% is the current rate. So the real rate of return is calculated simply by taking your nominal rate of return and subtracting the rate of inflation. And what you're left with is the real rate of return. This is what you're pocketing. This is what you end up with at the end of the year. Two quick examples. Some people, maybe many people, invest in short-term bonds and bond funds. You get about 4% plus or minus. I'm just rounding numbers off here for the sake of illustration. But that rate of inflation is 6.5% now. So if you do the math, you take that 4% you're earning, the nominal rate, you subtract the real rate of inflation at 6.5%, your rate of return, the real return, is a whopping negative 3.8%. So that means that at the end of the year, you've just lost 3.8% of the purchasing power of your savings, your dollar, or your retirement account. And that's a painful thing. Here's another quick example. Peer-to-peer lending, peer-to-peer loans have become pretty popular over the last several years. There are a lot of websites out there where you can shop for a loan to give to another individual or entity. And, that can be all over the board. But 7% seems to be, a fair number to use. So you take your 7% earning this year, deduct 6.5%, and you get a real return of 0.5%. It's almost zero. It's not zero, but it's still close to zero. So you're not really getting ahead, but you're not really falling behind. So I guess that was okay. But that's not good enough for me, and I'm hoping it's not good enough for you as an investment. Well, here are my favorite hedges against inflation. Now, I'm going to preface all this with two things. One, not all of these are going to make sense for you. They're not for everybody. And two, you might not understand some of these, and you might question why would I want to invest in some of these or one of these. But I can tell you that these are the most common and often effective ways to beat inflation. So the first is owning a business, a legitimate business, a viable business, ideally a scalable business, and one that's not so much a side hustle, although it can be. The reason I have business on here, and it's for many people, business is not an investment, but it certainly can be for many others, because you can invest in businesses, whether as a partner, a limited partner, a shareholder, a member, or maybe it's your own business and you're just investing or reinvesting in your business to beat inflation, because you can grow and scale a business. And that's really at the crux of it. Businesses can be grown and scaled. There's no cap. There's a glass ceiling as far as how big you can build it. And really your only cap is the size of your market. So if you're in a massive market, you can grow your business to whatever, size you want that to be, in millions or hundreds of millions of dollars of revenue. And then profit margins can be controlled, and there are very profitable businesses with high profit margins. So rather than go on a 1 hour talk about businesses, it's certainly one of my favorite, and that's why I'm involved in so many businesses. Secondly, this should be obvious to all of you, real estate is one of the most historically proven asset classes. It's one of the best inflation hedges, because what is real estate? It's a bunch of commodities that have been packaged together and built into a usable, serviceable asset that's on a chunk of dirt. You got sticks, bricks, copper, and concrete. You put it all together, and those things just naturally keep up with inflation. And so you've got, by definition, a bunch of commodities that you're leasing out to somebody, and those keep up with inflation. The cost to replace and the cost to rebuild is going to keep up with inflation. And that's why real estate is probably the number one most common and most favored asset for beating or keeping up with inflation. Now, this next one is where some of you are going to scratch your head. Don't roll your eyes, because you have to look at it in context. Yes, the crypto asset known as Bitcoin, if you look at it from 2009 to now, and you look at it on a trend, on a chart, and you look at the trend, it has like it has crushed inflation. Now, granted, it's extremely volatile. It's not for everybody. Not everybody understands it. I guess enough said. I don't really need to go into that all that much more. But if you bought some and you measure this in terms of years, typically in blocks of 4 years, you would have outpaced inflation in any 4-year block. All right, moving on. This is where I'm going to segue, and that is promissory notes. There are different kinds of promissory notes, which I'll explain to you here in a minute. But promissory notes, depending on what you're investing in, can meet or beat the real rate of inflation quite easily. And let's just jump right into that. So what is a promissory note? It's very simple. A promissory note is nothing more than a legal agreement between two people or two entities, a borrower and a lender. All that agreement does is it defines the terms of the agreement, or the loan, if you will. It's got an interest rate, a start date, and an end date. And you have signed, I'm sure, multiple promissory notes over the years. They include student loans, car loans, business loans, personal loans of all kinds. Even mortgage loans are essentially promissory notes, although they don't call them promissory notes. They call them a loan agreement, but many mortgages are actually labeled as a promissory note. And there's really very little difference between the two other than the size of the document. A promissory note, like a loan agreement, can be secured or unsecured, meaning it's attached to a piece of collateral like a car, boat, truck, or house, or unsecured, meaning that it's not attached to a piece of collateral but can have a foundation of other assets behind it. And the beautiful thing about promissory notes is they're ideal for retirement accounts. So if you have a self-directed IRA, 401k, or something similar, pay attention, because this is a great way to put your retirement accounts to work, probably better than what they're doing now, especially if you're just locked into cash or money market accounts. If you're locked into if you're sitting on cash or a money market account, based on the slides I just showed you, you're losing money. You're losing purchasing power because of inflation. So you're actually losing whatever that may be. It could be 0 to 8% or more per year. So the most common ways to invest in a promissory note, and these are going to resonate with a lot of you because I know there's a lot of real estate investors listening tonight. There are performing real estate notes. These are essentially just mortgage loans. Those can be paying you anywhere from 4 to 10% per year, depending on, a couple of different factors, how big the loan is, if you're in first or second lien position, all that kind of stuff. But it'll probably average around 6 to 7, maybe 8%, again, depending on the terms. Then there are those so-called non-performing real estate notes, which pay you a whopping 0%. Yes, I said 0 because they're non-performing. The only reason people invest, quote unquote, in a non-performing note is because they expect to turn it around and turn that note they bought at a discount into a performing note, where they now are getting monthly cash flow and now they are getting a rate of return of some kind. Also related to real estate are hard money loans. These are typically for buying, fixing, and flipping property. That's what hard money loans are. They're short-term, tend to be 3, 6, 12-month loans. Very short-term. The expectation is that you turn it around and pay it off very quickly, often in 6 months. And because of that, they charge a premium. You got points to pay on the front end, plus the interest rate. So they can be lucrative, but they also carry a fair amount of risk because you're dealing with a distressed asset, which is a distressed piece of real estate, and somebody who you hope is going to be able to renovate it, B, under budget, and C, in time, so they don't lose their profit margin because it's taking forever to sell, and you hope that the market doesn't change within the 12 months that they're doing that. Treasury notes, nothing exciting, 3 to 4%. That is under the real rate of inflation. Peer-to-peer lending is kind of interesting, although mostly misunderstood and not something that people are comfortable with, because you don't often know who you're lending to. It's like one individual to another on a kind of a crowdfunding platform, but you're not syndicating anything. Last but not least, my favorite, and one that I'll talk to you a little bit about here towards the end, small business lending. This is done every single day of the year throughout this country and all first world countries, where people and institutions are lending to businesses of all sizes, small, medium, and large. But that lending is done through a loan agreement or a promissory note. And those terms can be anything and everything under the sun. You can get very creative, but it's not unheard of to earn 6 to 10% or more, even as much as 15 to 20% on small business lending, because it's money that's being put to work in a viable operating business that that generates revenue and profit. And so this is how businesses grow and expand. They borrow either from banks, other lending institutions, or individuals, and those are done on promissory notes. So those are the ways you can invest in promissory notes. Real quick, what are the reasons to invest in promissory notes? Most of this should be obvious to you, at least by now. By far, the biggest advantage is they are some of the most truly passive investments. Once you've purchased and funded your note, you just receive your payments or your distributions on a monthly or quarterly basis, whatever the terms are in that note. But it's very, very passive. You don't have to actively manage it. There are no toilets and tenants. It's very straightforward. They are simple to understand, simple to implement. I don't like saying everything is easy, but in context, compared to other options, they are pretty easy. There's nothing complicated about a promissory note. They provide you an option for steady returns. I say an option because some notes are paid on maturity in full. But if you have distributions on a monthly or quarterly basis, then you do have steady returns. Notes are ideal for retirement accounts. Many of our clients, I'd say about a quarter of them, use a self-directed retirement account of some kind, whether it be an IRA, a 401k, I think a SEP, and there's some others in there as well. But IRAs and Roths are certainly very popular. But they allow you to keep more of your profits because retirement accounts like IRAs and 401ks come with tax benefits. So you can either defer or eliminate taxes altogether with a Roth account. And they obviously help you create wealth for your future because you can compound those returns because you're deferring or eliminating taxes that are earned on your investments in those self-directed accounts. You can compound those returns and they help you create wealth faster. So let's quickly compare some options. CDs, the certificate of deposit, or what I like to call a certificate of destruction. You get a whopping 0.4%. It could be a little more, could be a little less, but it's roughly around 0. Gold depends on where you're measuring start and end date, but it's been going up a little bit faster as of the past couple of months. But gold is around 1%. Oops. Bonds, 1.6%. Treasury notes are a little higher, again, around 4%. The stock market's kind of interesting. It's broken into two parts here. So if you look at the S&P 500 over I forget what the period of time is, but these are averages. And this was all pulled off of bankrate.com. So you can look this up for yourself as well. But if you invest in the S&P 500, you're averaging roughly about 7 to 8% per year on average, long-term averages. If you look at the stock market in the red bar, when you reinvest dividends, not a lot of stocks pay dividends anymore, but if you take dividends from dividend-paying stocks and you reinvest that to help compound your returns, then you can bump that up to about 10.5%. Mortgage notes we talked about a few slides ago, and that's going to be anywhere from 6 to 10% depending on the type of mortgage note, but let's just call it 6 to 8%. I took the high number at 8%. Last but not least, when we talk about corporate or business notes, that's what Norada Capital's notes are all about. Those promissory notes are starting at 12%. They average 15%. These are fixed, not variable. And you'll see that later on. There's basically only two tiers, 12% and 15%. And then there's a third tier with a bonus, but it's essentially 15% plus the bonus. So these are your options with traditional investments out there. Now, here's the big question. This is the question you need to ask yourself. Are you protected? The real question is, what are you doing to protect your savings and your retirement income against inflation? You can't escape it. It's there. It affects every single resident and citizen in this country. And the question is, what are you doing to protect yourself? So a couple of quick slides on Norada Capital. This kind of ties everything together. It ties the inflation conversation with what promissory notes can offer you And this is just one option. There are other companies out there offering promissory note investments tied to various asset classes, be it real estate, businesses, whatever else. But this is just one option, but this is kind of tying it together. So with our firm at Norada Capital, we offer investors an opportunity to invest in promissory notes. These are fixed double-digit returns. Again, they start at 12%. They can go up to 15% depending on the invested amount. And these are monthly direct deposits right into your bank account. So they're predictable monthly income distributions that you can see come right in at the beginning of the month. So this is a passive investment. That's how it's designed. Predictable monthly income. It's every month, double-digit returns. Our company, we've been offering promissory notes as far as 2012. So I guess that's about 10 years ago. No default history. Every note has been satisfied, which means it's been paid off. And our company has diversification. Our firm has invested in over 15 companies. I'll go over them really quick here over the next 3 slides. I'm not going to spend a lot of time on it. I can talk about it a little bit more at the end with some Q&A. But what I would encourage you to do is actually just have a conversation with my team of investment counselors. They're basically there to get into the weeds with you if that's how deep you want to go. Otherwise, I could talk to you for hours about this stuff. So first of 3 slides, this is just to show the diversification of our investments. You'll recognize most, if not all, but most of these names. We did a pivot about 3 years ago, 3.5 years ago. We saw that a lot of big name brand brick and mortar stores were filing bankruptcy protection. Usually they were Chapter 7s. And what we decided to do, my partners and I, we went in and offered them, we made them an offer. It was an LOI, a letter of intent. And we offered to buy all their intellectual property, which is their brand names, their trademarks, their website, their website URLs, and most importantly, well, very importantly, their customer database. So we wanted all their customer information, the database, and all the subscribers to their newsletters so we can market to them. And what we did is we acquired Dress Barn. That was the first nationwide retailer brand that we bought. And we let the trustee shut down all the stores, sell off all the inventory, and we basically took that business and rebooted it online and took our marketing team and started driving traffic to it, both warm traffic and cold traffic, and just let it run as an operating business entirely online. And that was such a successful model, that playbook, that we duplicated it over and over again. We duplicated it with Pier 1. We duplicated it with Linens and Things, Steinmart, Model Sporting Goods, and Radio Shack, some more than others. And we are continuing to grow and scale these brand assets. Now, in addition to those, we also have another type of e-commerce business, which is what they call a SaaS business, a subscription as a service, or a service as a subscription model. MentorBox is essentially like a book summary subscription. We have 60,000 paying customers at $10 a month. You can do the math. That's $600,000 a month in gross revenue. Our overhead is very, very small. It takes less than 3 people to run that business. So you can see our profit margins are very, very high, north of 90%. So very, very lucrative business. E-commerce is done right with the right types of businesses can be not only very profitable, but the beautiful thing that I love about online businesses is they're very scalable. You can not only control the business, and the revenues and expenses, but you can control how fast you want to grow it and how big you want to grow it. And this goes back to my 4 ways to beat inflation. Remember, the first one was businesses. This is one of the reasons why I love business so much, is because you can grow and scale a business to whatever size you want to grow it to. Now, this to me is one of my most exciting and important slides as far as assets held with Norada Capital. The top 3 are what I refer to as masterminds. The first one is a high-end 5-star true mastermind where its members meet 4 times a year in very, very nice places. It's $25,000 per year to join as a member. You have to be approved. but it's a very lucrative business. And we have one of the best masterminds out there with some of the greatest content, the greatest speakers, and education and networking, and a lot of deals get done at our Power Room Mastermind. Money is the name of our not our holding company, our operating company. Money is Mastermind. We're driving financial education to the masses, and we're ramping this up rapidly this year. We have 10 large events. The first one is in Dallas on March 16th. And we're going to have about one a month for 10 months this year. So that is selling financial education. It's also a mastermind. So members that buy into that are essentially purchasing financial education. They have a counselor, they have monthly coaching calls, they have weekly calls, they have 2 live events per year out of 4 that we do each year. So there's a lot of value that they get from that for a nominal cost. And it's really just a way to learn how to make money, grow your money, and protect your money. So there's a lot of tax strategy and tax education in there. Think Realty. Some of you may already know it as a very high-end glossy magazine that's available in bookstores as well. But Think Realty has expanded to be the same business model as Money is. So it's a Think Realty Mastermind. It's basically the exact same business model, but focused entirely on real estate education. For those of you that listen to my podcast and subscribe to my newsletter, and you can do that through any of our websites like Norada Real Estate, Norada Capital, you will get announcements through email of upcoming events in different parts of the country. So I suggest you subscribe. And I'm trying to go quickly on this because like I said, I could spend hours on all this, but I'm pretty excited about the bottom part. So we are, as I mentioned at the beginning, when I was talking about a little bit about myself, co-producing 6 new Broadway musicals. These are some of them. The one that just went live, actually Harmony is running, Joy is running. The Neil Diamond musical called A Beautiful Noise. The official opening night was December 4th in New York on Broadway. It was an amazing event. This is an amazing production. So if you live in the New York area, or if you are going to New York, try to go get tickets if you can and go see the show. It is amazing. But these are some great productions that we are putting on. I'm happy to talk about it offline or more later if you like, but these are just going to be some amazing Broadway runs that go on for years, and we're already seeing that with 2 of these productions. Broadway Vacation, which is based on National Lampoon's Vacation franchise, as you remember, Christmas Vacation, all those. This is based on that movie franchise. Okay, last slide real quick. We have some crypto asset projects and crypto assets on the books. Not going to go into detail too much on this. It's something I can certainly talk about. And then real estate makes up a pretty small portion. So BRD, Land and Development, that's a land development company. We sell literally thousands of lots, paper lots, to home builders like D.R. Horton and Stanley Martin. Then they take those lots, get the permit for it, and then build homes on it. So we've been selling nationwide home builders lots through our own acquisitions, and it's a very profitable business and something we really enjoy. To a lesser degree, the Imagination Vacation Rentals is a new venture. These are short-term rentals. And last but not least, In Pickleball, this is the leading nationwide magazine for pickleball. It's been, we've gotten tons of media attention on this. We're actually on the Stephen Colbert show. Stephen Colbert is actually on one of the covers. We have Katie Couric on the cover on 2 other issues. So it's actually known as the leading publication for pickleball in the country. All right, let's talk about real quick, one slide, the promissory notes. So this is basically how it works. You can choose your term. You can choose a 3, 4, 5, 6, or 7-year term for your note. There's no difference in the payout or the rate of return. Some people want longer term, some people want shorter term. I get asked, why is that? And the reason is this: how long do you want to lock in that monthly predictable income that is basically just ACH or direct deposited into your bank account? Some people want the longest term. Other people are saying, well, maybe in 3 years, I'll take that capital and invest in real estate, or my son is graduating from college and I'll need the money for, or graduating high school, going to college, I'll need the money for college. Well, that's great. You could choose your term, and it's simple as that. The rate of return is in the table below. So a note of 50,000 or more is 12% per year. A note of 100,000 or more is 15% per year. Again, all these are paid monthly. Investors that are at the 200,000 level or more is still receiving 15% per year paid monthly, but there's an extra bonus, which you'll see now on the slide, of 5% on that principal on the maturity date of that note. So when your principal's return on the maturity date of that note, you get an extra 5% bonus. Payments are made monthly. It's direct deposit. We use Wells Fargo's direct pay. So you're set up with automated scheduled payments that leave our company account on the first of the month, and they drop into your account on the second of the month. Unless it's a holiday, then it's on the third, but that's typically the schedule. The payoff is repaid on the maturity date of the note. The minimum is 50K. Now, we have made exceptions at 25. We don't normally do that, just stating. And the start date is the first day of each and every month. That's basically the long and the short of the promissory note. This is my last slide. Sometimes I get asked, what's the next step? There's two options here. You can schedule a free strategy session with my team. We have investment counselors that can answer all your questions and help you strategize and see if this is the right thing for you. And then, of course, if this is something you are interested in, you can just fill out the profile form on our website at noradacapital.com. And if you just look at the URLs on the screen, noradacapital.com/profile will take you straight there. Otherwise, there's a link on the top right of the website if you went to the home page. But these are just direct links to the calendar scheduling and the direct link to the investor profile form. All right. Thank you very much. I talked really fast, and I just had a lot to cover. So it is 5:48. We have, let's just call it 12 minutes before I wrap it up to respect your time. Again, I want to thank you for spending time with me. I'm going to go to the Q&A box and answer your questions. I may not get to all of them, but I'm going to do my best to answer as many as I can. All right. Okay, I'm not sure what MI is for a name, but you can invest 60,000, for example, does not have to be, yes. So you can invest any dollar amount you like as long as it's rounded to the nearest $1,000. So if you wanted to invest 60,000 from your savings or your self-directed account, whatever it is, that is fine. Our published minimum is 50, but if you wanted to do 50 or 55 or 60, that's fine. That's not a problem. Sample contract, Scott, yes. If you actually go to the website, you can download a summary information package, which, by the way, I am rewriting. There's going to be a new one in about a week or less, as well as an investor's deck. So that is my goal, is to have it done by this weekend, and I'm working diligently on it, which it'll be made available to all of you. But yes, in that packet you could download from our website, there's an example contract, like a promissory note, and you can talk to any investment counselor and they'll email it to you as well. Dino, you're welcome. He said, this is awesome. Thank you. You're welcome. I'm glad. Dino's actually one of our clients. Let's see. Anonymous, what is the internal rate of return on a $200,000 plus rate? Darn good question. I'd have to get a spreadsheet and run that for you. So I don't know. It also depends on the term. So you didn't give me enough information here to answer that question. But your internal rate of return is going to be pretty close to the interest rate on that note. It's going to be very, very close, because keep in mind, these are annual rates of return. So it's not going to deviate much from that. Yeah, Jackie, interested in a free strategy session, just go to noradacapital.com. If you go to /calendar, you'll go right to the booking page. Do I have to be an accredited investor if I use a self-directed IRA? Yeah, very good question. Yes, you do, because it's your self-directed IRA. Now, I'm reluctant to mention this. There is kind of don't want to call it a loophole. There is an exception to the rule. Talk to one of my investment counselors if you're not accredited. There is an alternative note structure that will allow you to invest. It's a much shorter term, but we can still work with you. So I will say we're very selective, maybe picky is a better word, working with any non-accredited investor. So you need to have a conversation with our investment counselor. Let's see here. Okay, same thing, same question about accredited. Again, talk to an investment counselor, Christopher. Can people from Canada invest? Also, do you have to be accredited? Okay, so that's 3 in a row. You can invest from anywhere in the world. Oh, that's interesting. You got the same name as me, Marco. Nice to meet you. Yes, you can invest from Canada. We have Canadian investors. The country doesn't matter. You just have to disclose it on your personal tax return in the country that you reside in. How is your business recession proof? I don't know of any business that's truly recession proof. However, if you look at the performance of certain businesses, like e-commerce businesses specifically, you will see that they do well during recessions. If they have a negative impact, it's very subdued. But often, e-commerce businesses actually perform just as well, if not better, during mild recessions and moderate recessions than they do during good times. So there's no such thing as a recession-proof business, but there's a word I'm looking for: recession resilient. I forgot. I'm not too concerned. Now, I will say this: you could argue that we are in a recession now, but the media is not talking about it all that much. We probably will see some sort of mild recession this year. I mean, that's the general consensus amongst most people. If that happens, I believe the Fed is hell-bent to help minimize the impact of a recession. So they call it a soft landing in the mainstream media. That is their objective and goal. So they don't want the U.S. economy to go into a deep recession. Okay, Carl Powers. Well, I guess I shouldn't say a last name. Carl, what's the risk to my principal? Okay, again, good question. So what I call a worst case scenario or risk is essentially what I refer to as a black swan event. It's the unknown unknown. So I know this sounds extreme, but let's say another major world pandemic is an unknown. That could impact all businesses, not just ours. It would certainly be a kick in the teeth, but it wouldn't be destructive. A world war, a major regional hot war, aliens coming down and scooping us all up. I mean, we'd have bigger issues to deal with if that was the case. So there's no such thing as an investment that has zero risk. I would never tell you that, and don't let anybody ever tell you that. But I personally believe that because of our diversification, the revenues and the growth of our asset portfolio, our business portfolio, I would just call this a not very low to moderately low risk level. When did the bonus go up to 5%? It didn't. The 5% has always been 5%. What is the chance that your return rates will change after 3 years? It's possible. 3 years is a long way away, so I can't say for sure. Can it change? Yes. Will it change? Probably not. But if I was to read between the lines, I'm guessing you're asking that because you're opting to go with a 3-year term as opposed to a longer term, and wanting to basically come back in at whatever rates are going on then. Yeah, I can't guarantee that we're going to have the 12 and 15% in 3 years. It could be lower. It just depends on the environment, the market, the environment, the economy, those kinds of things. So JB, that's kind of the best answer I can give you. Do you provide a 1099 or K1, Gerald? Yes, it's a 1099. Every January, you're going to get mailed a 1099 INT statement. And then you just, unless it's in a self-directed account, if you have tax deferred or tax-free account, that it's not applicable. but yeah, you would get a 1099 to reflect on your either your personal tax returns or your business returns, whatever the case is. Thanks for that, Gerald. David, correct. Did I hear you say that your investments have never defaulted? That is correct. All notes have been paid. Some notes back in 2015, 2016 were paid later than the maturity date, but that's because they were directly tied to investment real estate. That's when we were buying, fixing, and flipping literally hundreds of houses in Missouri. And so each note was independently attached to a property. And that's the problem with having secured notes attached to real estate, is you have to wait for the real estate to be liquidated or refinanced. Vicky, do you have a maximum number of investors that you can take? No. I had to think about that one for a second. No, there is no cap, because this is not like a typical syndication where you have a target dollar amount. It's really based on deal flow. So we raise capital to keep our war chest loaded for deal flow and expansion of our existing assets, our businesses. When we don't need the capital anymore, we're going to just put a pause or stop to the capital raise. So as long as there's a use and a place for it, and where we can arbitrage it and make money, we will raise capital. When that is no longer the case, we'll pause or stop. Michael previously mentioned, how long have you been offering this investment? So as early as far back as 2012, those were all project specific up until when we formalized the capital raise under Norada Capital Management, which was about, I think, 3.5 years ago. We just decided, okay, let's formally structure this so it's an ongoing capital raise, not a project specific capital raise. Are there anonymous? Are there any additional expenses or fees associated? No, zero. That's a great question. This is a zero fee fund. It's not like a 2 and 20 fund, or where there's a management fee or a fee for assets under management, or an entry fee or an exit fee or a commission or anything like that. There are no fees whatsoever. We're making money from the businesses that we are growing and expanding and acquiring. So we don't need to charge you any fee on your capital. We're already making money on the capital. So that would be like double dipping. And although we could do that, we just never have, and we won't. These are all great questions. Boy, there's a lot of them. Wow, there's 57. Okay, so Lisa, who's the borrower on the promissory note? Yeah, so I briefly mentioned this on one of the slides. So there's a borrower and a lender. You are the lender, or your entity, or your self-directed account. The borrower is specifically the company, Norada Capital Management, LLC, which is simply Norada Capital Management, or we just refer to it in short as Norada Capital. So that's the borrower. So your promissory note is made between you or your entity, party one, and party two is Norada Capital. Melanie, okay, yeah, follow up with me on that. Yeah, that's what you're saying. Fred, when purchasing these notes through a self-directed IRA, are they typically purchased by the LLC inside the self-directed IRA? Okay, again, good question. So some people have their self-directed account set up in a way where they have an LLC or an entity inside your self-directed account. If that's the situation, and you can do this either way, but most people who have that set up are essentially making that investment from the LLC inside your IRA. So the answer to your question is yes, it would be done through your LLC in your IRA, but it doesn't have to be. You can still just invest directly from the self-directed IRA and have your LLC within there investing in something else. So Phil's asking, what does accredited mean? Okay, accredited means, according to using the SEC's definition, you either or. A, you earn, I believe it's $200,000 or $250,000 per year, and you've done that in the last 2 years in a row, or you have a net worth of $1 million or more. And $1 million excludes your principal resident, but includes everything else. So it includes real estate, precious metals, crypto, stocks, bonds, mutual funds, anything that is an asset that you can put a dollar amount to and you can sell, that is part. Marco, thank you for answering. Marco, excellent webinar. You're welcome. Paul, okay, Paul. So we don't, actually, this is going to change in about 6 months or so. We will have financials made for public distribution from various entities, not all at the same time. Yeah, so talk to me about that, because right now there's we have pro formas and we have other documents that we share, but those are in the works. Dave, same question. Do you receive a 1099 or K1? It's a 1099. Let's see. That's a long question. Is it okay, Lisa? Is it possible to get the principal back before the term maturity? Okay, a good question. So when you invest in a promissory note, or at least our promissory notes, I can't speak for other notes. They become illiquid. So that means that you're locked in for that 3-year term. However, this is just me saying it. This is not in writing, because there is language in the promissory notes that shows or tells you that the notes are illiquid, meaning you're locked in for the term, whatever that term is. But if, let's just say, you have some sort of medical emergency or catastrophic event going on in your life, contact me directly. And there's a high probability that I can help you. We'll just pay off your note and just cash you out. Of course, your distributions will stop. But as far as the language in the promissory note, the contractual language, there's no liquidation, early liquidation, if you will. So, okay. Will you accept an IRA trust where at least one of the beneficiaries is not accredited? That's a good question. One would be accredited. I believe the answer is yes to that, Sandra. I think we would just take well, it's a profile, it's not an application, from you directly. I need to look into that specifically, but I believe the answer is yes, because the other person is riding along with you. So yeah, I believe the answer is yes. Don't quote me. I have to look into that. What percentage of the fund is in each business, multifamily, Broadway shows, etc.? Chris. So approximately, I'm working on these numbers right now for this new information packet that I'm putting together. So this is a timely, interesting and timely question. It's approximately 50% or so on the e-commerce businesses. I divided it into 2 buckets. The e-commerce businesses are about 50%. And then the rest of it is the other 50%, everything else I covered. I will have more accurate numbers on that by the end of this week, and that's going in that packet. So, so you'll get the more specific answer to that pretty soon. What is your worst performance and what year, Vicky? There was no worst performance because the rate of return on the note is fixed. So if you're locked in at 12 or 15%, that's exactly what you're getting. It's not variable. It's a fixed rate of return. But if you're referring to us as a company, believe it or not, COVID was a stellar year. Like 2020 was a brilliant year. We made great acquisitions that year, and it was one of our best years in terms of sales and revenue. Can I reinvest the monthly distributions instead of receiving the monthly cash, Arthur? Arthur, no. We're not set up to do that. We're not set up for you to just have your funds because your note is written one time. It's for a fixed amount, and you're just going to continue to earn from that. Now, you can take those interest distributions and pool it with additional capital, and then either purchase a new note, or we can rewrite and replace the original note for a higher amount with those new monies, those distributions, as well as what other capital you add to it. As long as the number, the principal amount is a rounded $1,000. So we don't want like $100,125.25. If you come back on that $100,000 note with, let's say, another 5,000 or 10,000, we'll just reissue a new replacement note for the $105,000 or $110,000. but no, there's not like a monthly reinvestment. Michael, what is the money being used for exactly? I covered that during the presentation. In short, it's basically the acquisitions and expansion of those 15, 16 companies that I just showed you on the slides in the portfolio. And this is being recorded, so you can kind of go back to that, or just contact our team and you can get more information, as well as the new information packet that will be available next week. Okay, so we're at 6:06. I'm going to take a few more and then wrap it up because I want to respect your time, and I've passed the top of the hour, and there's still a lot more questions coming in here. Is there a preferred custodian? I assume you mean a self-directed retirement or a self-directed trustee. Yeah, we have preferences. Equity trust, off the top of my head, is probably my number one recommendation. We're tied in very, very, very closely with them. In fact, I know the CEO and several of the VPs, and we actually have a working partnership. In fact, they are tied in directly to two of our companies. The Money Is Mastermind, tax-free crypto, they're a partner in. And I believe they're also piggybacking on Think Realty and Think Realty Mastermind. So I always recommend them, but they're not the only game in town. They are the biggest in the country. Yes, directed IRA is another great one. So those are two. If you want more, we'll give you more. We have kind of a short list of companies that we recommend. Franny, is the 15% on the note a fixed rate of return? Yes, like I said, all these interest rates are fixed. There's no variables. Okay, I already answered that one. Yes, Norada Capital is a 506. This is Dawn. Norada Capital is a 506C. It's a Reg D filing. It's a 506C filing. So Dawn, if you're still on, there's your answer. Tony, can the interest go straight into the IRA and I can roll it over into a Roth later? That has nothing to do with us. If you're invested in an IRA and you want to do a rollover, you have to talk to your custodian or your trustee to do that conversion from a traditional IRA to a Roth IRA. So yes, as long as they allow that, and you have the ability to do it, then do it. But that's your choice. That's not for me to decide, or nobody can tell you to do that. That's your option, I guess. Let's see what else we have here. I'm going to keep scrolling. Greg, I love Milton Freeman. Bliss, yeah, okay, funny. Dave Newman, did I make a math error? I have to go back to that slide and check. If I did, I apologize. That was my mistake, but I think the point was well made and illustrated. Okay, Jeffrey, I'm a military retiree on a pension with 500,000 cash plus or minus. Jeffrey, contact my team and I can have a conversation with you as well. Yeah, I mean, I can't. I'm not exactly sure what you're asking. Actually, I answered your question. So yeah, contact me and my team. We can help you with that. Nick, what is the major risks? I answered that previously with someone else's question about that. What recourse do we have if the worst of the worst were to happen, as in like a default? Nick, okay, so I talked about worst case scenarios, and to me those are like major global recession, major economic collapse, deep, like a depression or deep recession, world war, another major pandemic, things like that. These black swan events is really where I see things impacting the company, and really there's bigger problems at that point. It's not just us, it would be businesses across the board, local, small, medium, and big, or institutional size. So as long as we've got revenue coming in from the businesses, we can service the notes. I mean, that's the debt service side of the business. But if I took that even to a further extreme, where let's say Norada Capital was incapable of servicing the notes. I don't see that happening. So I'm talking like worst case scenarios here. There is language in the promissory note where Norada Capital can issue equity in the company, so shares or ownership in the company equivalent to or greater than the principal amount invested. And so, you know, if there's a default in payments, your note still stands, you know, that's on the books as owed to you. So we could issue you equity in the company equal to or greater than what that original principal was. I don't ever see that happening. Has it ever happened? No, it's just language in there as one of the, you know, not option, but modes, if you will, of dealing with a default should it ever happen. So interesting question, Nick. Let's see, Jackie, interested in free strategy session. A lot of these are duplicate questions. Do you have references, clients that have exited after term? Yes, Michael. Just talk to one of our investment counselors, like Michael here or Nate. Yes, we can certainly put you in touch with people, no problem. So, okay, it's 6:12. Maybe let me see if I can pick one more, and then I will wrap it up for you guys, and I'll make this available as a recording. Did you? I think I answered that. Now I'm kind of choosing, trying to find ones that I haven't answered yet. Okay. I think I probably covered the majority of them. All right, guys, gals, ladies, thank you for spending this hour and 13 minutes with me tonight. You've been great. If you have any questions, contact my team, and we'd be happy to have a conversation with you and answer any questions you have. So have a good evening. Have a great week. Thank you for your time. And hopefully we'll talk to you soon. Good night.